Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome, everyone, to this featured Voices podcast. I am your host, Chris Martenson, and it is January 29th, 2019. Now, if you've been listening to me for any length of time at all, you know that I consider our financial markets to be so distorted and so deformed after far too many years of central bank interventions that they no longer deserve to be called markets. Instead, I put not one but two sets of quote marks around the word markets to signify just what a travesty they've become. A market, as a reminder, it's a place where buyers and sellers engage in something called price discovery. A market, by contrast, is a place where non-economic players gather to influence prices to reflect certain specific policy aims, or where overly large players enact greedy smash and grab operations on the price levels of financial assets. Now, sometimes they smash them down lower to engineer conditions to make money, and other times they smash them higher. But with that said, everybody listening to this grew up with the same idea I did, marketed to all of us, which is that stocks are a legitimate form of investment. Perhaps the only and most important part of investing. Stocks for the long haul, buy and hold, dollar cost averaging, fundamental analysis. Just employ any of these strategies, and that's the path to building wealth. Now, our guest today has another view, which is even more fundamental than my own observations about broken markets riddled with conflicts of interest. Tan Liu is the author of the book, The Ponzi Factor, The Simple Truth About Investment Profits, which explodes some of the most enduring central myths about stocks and stock investing, as he makes the case that the stock market is a scam at a foundational level. Now, if you're an investor, you absolutely have to hear what he has to say. It's a very well-written book that takes you through stocks or equities and what they truly represent, using really simple, really easy, yet very solid logic. Now, if you are holding or thinking about buying stocks, you really should be familiar with this logic, so you can at least be a fully informed investor. Now, here's a bit of background on today's guest. Tan Liu was born in Beijing, China. He moved to the U.S. when he was 6, and he was raised outside Washington, D.C. And unlike his sister, who finished high school and got a scholarship to MIT, Tan took a less traditional path and went straight into the working world. He was employed as a bike courier after high school and later supported himself through college as a freelance photojournalist for networks such as CNN, MSNBC, and Fox. But in addition to his professional life, Tan has also spent many years volunteering as a youth mentor in D.C. and in Inglewood, California. In 2006, he completed his undergraduate degrees in economics and finance from the American University, and he's worked for 2 hedge funds and a trading firm in Shanghai, but spent most of his finance career managing distressed assets for a bank. He officially exited the finance industry in 2015 and now is finishing a master's degree in applied statistics. Welcome to the program, Tan.
Thank you for having me, Chris.
Well, Tan, you say that stocks are, in many cases, indistinguishable from a Ponzi scheme. Take us through that. What's your reasoning?
Sure. Well, when it comes to stocks, there's 2 ways of making money. There's capital gains and there's dividends. Dividends, there's nothing wrong with that because that comes from the profits of the underlying company itself. The issue is with capital gains, the whole buy low and sell high gamble that is often promoted, not often promoted, I would say 99% of the time promoted on MSNBC or CNBC, financial news networks, and also the focus of a lot of financial research. The issue with capital gains is it comes from other investors. When one investor buys a stock for $100, they're selling it for $110, that extra $10 or actually $110 they're getting is not from the company. It comes from another investor who will then need to sell to yet another investor. So when one person buys low and sells high, another is also buying high and needs to sell for even higher. In a system where current investors' profits are dependent on cash from new investors is by definition how a Ponzi scheme works.
So let's talk about what stocks. I love the way you started the book out, and you talked about what a stock really should represent. And originally, a stock was representing it's sold as you're part owner of a company, right? And that's, I think, still, if I turned on CNBC, that's all they would represent it as. You are an owner of a company. What's wrong with that?
What's wrong with that is a lot of stocks don't pay dividends, and why are you an owner of a company if the company never pays the so-called owners, right? Yep. I mean, it really comes down to that simple fact. And it's funny because over the past year, I've debated with a lot of people, and essentially all my critics of the book, what they're ultimately trying to rationalize and argue is that owners don't need to receive money from the companies they own, okay? Which is really twisted, but that's exactly how it works. Because when a stock doesn't pay dividends, there is no monetary connection between the revenues and profits of the company and the actual shares. And the only thing that's really increasing is just this Ponzi process of one investor trading money with another investor. And it's fundamentally different from the money itself that investors ultimately want. No one actually wants to buy stocks and say, hey, I don't ever want my money back. I just want stocks, okay? and I want to watch that value grow, and I never want my money back. Wrong, okay? Everyone wants their money back because a stock is essentially completely worthless unless you can get your money back. And every investor that buys stocks wants more money than they contribute. But if investors are the only ones contributing money into the system, how on earth can they all make money from it? And that's really the bottom line. A stock without dividends is really just a Ponzi asset, and there is no monetary connections to the company, so therefore it's not a real equity instrument at all. And furthermore, we could see this because some people say, oh, well, stocks are real property. How can it be real property if literally companies can print this stuff like toilet paper at any time they want? Real property takes time to replicate. Try replicating a house. How much labor does that cost? How much resources does that cost? Try replicating a stock. It takes a signature. I mean, companies are printing billions and millions of these things, millions and billions of these things every single day. It's not real property if you can just literally replicate it and just throw it out to the so-called market and just have people gamble on it anytime you want with almost no effort at all.
Now, I want to get to this idea of gambling versus investing because it's a great point you make in the book, but I really want to make sure we drive this home. So there's really only two ways you can get money back after you throw money into the stock market. So let's say I buy, I'll just make some numbers up. I'm going to buy a share of Google for $1,000, right? I don't know what it's trading at right this minute, but so I put my $1,000 in, and there's only two ways I get my $1,000 back or more. One, I have to sell that share to somebody else, right? And if I do well, somebody pays me more than I bought it for, and if I do poorly, they pay me less, right?
Correct.
The other way would be through dividends. Now, the only thing that really identifies that you have an ownership stake in the company, though, is if they give you money back in the form of a dividend. A company has no ability really to influence what your share price is you're going to get back. We'll get to corporate share buybacks in just a minute, but otherwise, like once it's out in the secondary market, their shares are just floating around. And people are buying and selling them, hopefully for more than they sold them for. But your point, which really needs to be elucidated, is the only way you get more money for your share is if somebody else gives that to you. It's not floating around out there in the market somewhere, right? It's sitting in somebody else's bank account, and it's got to be liberated from their bank or brokerage account and come back into yours, right?
That's correct. And I will also add that the only foreseeable way, okay, this is very important. The only foreseeable way it is that, because the critics will argue, oh, but Google could pay dividends, or basically Google could buy back stocks later or something like that. But those are hypothetical situations. Okay, you can't compare a hypothetical situation about what a company might do in the future compared to the Ponzi process, which is completely observable, completely provable, and something we can witness every single day. You can't debate an observable event with something completely hypothetical. I mean, the only foreseeable way people can get their money back, yes, is by selling it to another investor.
All right, and let's cover this idea of dilution, which is the idea that a company might have 1 million shares outstanding, but with the stroke of a pen, they might have 1.1 million shares outstanding for a 10% dilution. This is happening all the time, isn't it? A lot of companies pay with options to their senior employees.
Yeah.
And so they are constantly, quote, air quotes, you're paying, but they're paying with obviously other investor money that exists out in the market. Because if I'm an owner of I'm an executive in a company, I get stock options. I now take those to the market and I release them to the market. I sell them and I take that cash, right? So this is happening all the time too, isn't it?
Absolutely. Yeah. Tesla Motors, their shares outstanding practically doubled since 2010. They started around 95 million, they reported in 2011. Now they're at 172 million. And God knows what it'll be when their Q4 comes out next week or this week, later on this week. Amazon as well, over the past 20 years, they printed about 131 million shares. And what's so funny about the delusion thing is, how does a market cap formula work, right? The market cap formula works, and the way they value a company is by multiplying the price and the shares outstanding. Okay, so needless to say, we all kind of established that dilution is a negative thing for shareholders, but in the market cap formula that everyone uses to value a company, it actually increases it. Okay, it actually increases it. The reason why Tesla is worth twice as much now is because they printed twice as many stocks by now. Okay? I mean, these finance formulas. Yeah, so we're actually touching on a slightly different subject now, but the finance formulas that I've looked at that people use are literally ludicrous, and they use them all the time. But yeah, it actually rewards delusion, the market cap formula.
So this is a really important point, and I want to get into this more because you did a wonderful job taking us through a number of fallacies that exist around the stock market. Let's get to the first one, is that stocks are equity instruments that represent ownership. You're calling that a fallacy. Why is that?
Yeah, because one, there's no monetary connection, like I mentioned. And also, two, if we look at some stocks right now, like Google, they don't even have voting rights, actually half their shares, which makes about, I think, 600 billion market cap. Half their shares are C shares. So those things don't pay any dividends, and there's no voting rights. So you own that thing for $1,000. You're not going to get any money from Google, and you're not allowed to say to Google what you want. So
what do I own?
Exactly. What do you own, right? And the whole idea about voting is also complete garbage. I'm not going to go into too many details about that, but it's very obvious if you look at the difference between Google A shares that do have voting rights and Google C shares that have no voting rights. Okay, the difference in trading price off of, let's say, $1,000 is about $1. Okay, or $2. All right. So let's just assume, economics are in play and stuff like that. What that's saying is that no one, the right to vote has absolutely no premium that exists at all. And also, I guess you could also look at it this way. Voting only works is if you're a company and you issue these stocks and you issue a set number of votes, and that's that. But the problem is that's not how it works. The companies can manipulate these votes. One is through delusion, like we just talked about, which is they could just print more votes. Another is they just do these shady splits and do all kinds of things which I can't even imagine, which basically lawyers get to it, and they have all these ways. Google shares weren't all C shares before, or basically half of them weren't C shares before. Google shares at one point were all A shares. In 2014, they did a shady split where half of them were C shares and half of them were A shares. So voting only really works is if there's a set number of votes, and that's that. But the reality is, in the voting system, when it comes to stocks, is these companies can manipulate these votes at any point in time they want, and they do manipulate these votes at a lot of times. So, yeah, the voting thing itself is also not there. But most importantly, I think people forget is that the reason why stocks were equity instruments to begin with is that they all pay dividends according to history. Before the 1900s, all stocks paid dividends, and there was a monetary connection between the shareholders and the companies that they owned. And that's how stocks are supposed to work. It's supposed to be that simple. You buy a piece of a company, they make money, you make money. But that's not how stocks work now. This idea that stocks can literally have no dividends and these companies can make billions and never pay dividends indefinitely, or these companies can continue losing money and keep printing stocks, in the case of Tesla and many others, is a new concept that came out over the past 100 years or so. So the way that stocks work now is fundamentally different from how they actually were designed to work and how they worked before the 1900s. And a stock without dividends, when there is no monetary connection to that company, should never be seen as an equity ownership instrument.
with equity ownership sort of implying, or even definitionally, including the idea that you have some ownership stake in the company, meaning you would have voting rights, you would have some claim to the assets, and you would have some claim to the cash streams that were coming out of the profit streams that were coming out of this, right? So what is the definition of an equity if it provides none of those things?
Yeah, exactly. It doesn't fit the definition at all, right? It doesn't fit the definition at all. And what does fit the definition of how capital gains work is that it fits the definition of a Ponzi scheme, because the only way you're going to make money is by taking it from another investor. And the only way people, what the earlier investors think is that they're thinking they're making money from the underlying company, when it's not. It's actually coming from another investor. But it does not meet the definition of equity, because equity, you're supposed to have an ownership instrument. You're supposed to receive money from the company. But if you're not actually logically connected there, then it's just simply not there. Now, I will add, though, is there a connection at all between the stock price and what the company does? Yeah, it's called a speculative connection. Okay, speculative. But you know what else exists in terms of speculative connections? Everything has a speculative connection. Everything. Okay, yep. I could draw like a speculative connection between what I'm going to eat for dinner and the performance of a basketball player. Okay, I mean, it's just so everything has a speculative connection. They're pseudoscience ideas that are not quantitative, not logical, but simply speculation. That's it. So that's the issue. It's like, there's no monetary connection, and these are nothing more than speculative instruments based on speculative connections with a company.
Well, now a whole giant machinery exists out there, Tan, of course, to keep this whole thing going, because with a rising stock market, it signals to people all is well, and they tend to be happier, and they like to borrow more and spend more, and so that's sort of the consumer consumptive model that we've got. Lots are in support of that, but what you're saying is that you had one example in the book, which is still very applicable today, and you mentioned it already, so I'll bring it up: Tesla. Right. So at the time, Tesla, you have a chart that picks it up. It's probably trading at around $40 a share where you pick it up, and it goes to, I forget what, $450 or something in the time frame. And during that period of time, it had lost over 10 years cumulatively about $4.5 billion.
Yeah.
So what's the thinking that has to be in place for somebody to say, this is a great investment, I want to own this?
Right. You mean from a finance person's point of view or something like that?
Yeah. What's the mindset you have to hold? Like you have to believe in something, and the belief is, I'm going to get my money back. This company is going to make a ton of money.
Yeah. So the classic belief that people would apply to that is the stock price represents is a reflection of future cash flows. That's the classical theory they'll apply. Now that's one just the complete garbage, because one, that's not provable. Okay, I mean, oh yeah, sure, it's a stock price now because it's based on something in the future. Well, you know what? I can't prove you wrong, but you can't prove yourself right either. That's called pseudoscience. Okay. Furthermore, if we look back at Tesla, then let's say, okay, so based on that theory, then in 2011, I guess the shareholders must have thought that their stock's going to accelerate up to $380 and over the next 5 or 6 years, while the company loses $4.5 billion. Was that their thinking? Seriously, if we apply that logic, it's a future cash flow, right? It's an expectation of future cash flow. Well, now we are in the future. Okay. Now looking back, actually, I'm just going to quote the statistics as of now, not in the book. Now looking back, Tesla has lost $6.5 billion over the past 8 years. And the whole logic of this whole idea of, prices reflect future earnings. Well, if we look back at 2010 and we see what happened is, if that is true, then investors literally thought that this company was going to lose $6.6 billion and their shares are going to double, which is why they invested and why they expected the stock to go from $20 to $380. It makes absolutely no sense at all, but that's exactly what that theory implies, looking back with the benefit of hindsight.
Yeah, I'm looking at that chart now. Yeah, high of 380 there. And so this whole idea is that it's really important to just bring it back to basics, because listen, what you're really doing here is countering decades and decades of really aggressive marketing. I keep thinking back to, I'm sure you're familiar with it, the famous lunch scene in Wolf of Wall Street. I love this scene between Leonardo DiCaprio and Matthew McConaughey, yes, right? Yes, where he basically is to the young ingenue, Matthew is saying,
Yeah.
listen, our job is to take home cash in our pockets at the end of the day. Your job is to keep them fully invested. If you have another idea and he makes money on it, you got to get the next idea. So it's selling, and selling this idea.
Yes.
But if you strip all that away, forget the marketing, really, you're putting money in today because you want to get more money back in the future. There has to be a mechanism for getting your money back in the future. So if you take a company that's not paying any dividends, you only have one mechanism available to you to get more money back, and that's to sell it to somebody else for more. Right? Have I missed anything in that story?
No, you're absolutely right. And I think it's the biggest, perhaps, smoke and mirror that's there is people still, over the past year, one thing I realized is that there's a serious difference between knowing and realizing. As in, a lot of people will say, actually, I would say everyone will be comfortable saying, yeah, I know stock isn't real money. I know it's just paper profits. Everyone, they don't have a problem saying that. But if you ask them the same, if you rephrase that and say, can you literally say to yourself that if I have $40,000 in my 401k, I have $0? Okay. That statement is equivalent to saying stocks aren't real money, it's paper profit. A lot of people will have problems saying that second statement. What they will say is, yeah, I have $0, but I can sell it. But, they'll always add that but. But no, don't say but. Just end it right there, okay? Don't add anything to it, okay? And that's the difference between knowing and realizing. So even though everything, what we explained is exactly how stocks work, which is, you have to sell it to someone else. And if you actually have $10 in your stock account, you have $0. And if you have $10 million, you also have $0, okay? There's no difference there. You have $0 right now, real money. But a lot of people will have problems acknowledging that, and it does take time to acknowledge that. So a lot of people will listen to what we're saying, but still say, yeah, but I gotta hedge my money. I gotta make my money grow. Your money's not growing if you got $0 in there, okay? And the only way you're gonna get it back is by taking from somebody else later. Money does not magically grow like that, and that's the issue with a lot of the way that people think. So yeah, it is just a system where you have to get your money back from someone else. And people forget that when they own a stock, the moment they buy that stock, their money's gone. It's gone. And the only way they'll get it back is by selling it to a different investor. Now, I would also add that this is fundamentally different too. A stock is fundamentally different from a house and a car, because I get this a lot. Well, isn't that the same thing as buying cars? Isn't that the same thing as buying a house? No, they're totally different, because if you can't sell a house, what do you got? A house. If you can't sell a car, what do you have? A car. If you can't sell your stock, what do you have? Nothing. Okay, nothing. So they're fundamentally, so this is the issue. Stock is essentially worthless unless you could sell to another investor. And unfortunately, that's just the only way that the only foreseeable way that most investors will get their money back.
Well, but Tan, I have a lot of Google C shares. Clearly, they have some value. They have par value. Right? Par value,
yes. Yeah, right in the front of their SEC 10K, par value of $0.001, right? 1/10 of a cent, right? Yeah.
So for every 10 Google shares, you got $1. I mean, no, sorry, you got a penny.
Well, every 100, yeah, exactly. Exactly.
All right, so a small loose thread from before, but it's been sticking in my craw for years. This whole idea that, and I hate the marketing behind this, that companies are returning cash to shareholders when they engage in a share buyback. Do you agree with that or disagree with that phrasing?
It is a big assumption. I disagree with that phrasing completely, because they don't focus on the dilution aspect, which is that companies issue shares before and after the buybacks too. Google, for example, engaged in a share buyback of 5 million shares in 2016. Well, that's what they announced, and they probably did. But if you look at their SEC 10K, you'll see that their shares outstanding did not decrease by 5 million shares. It actually increased by 3 million shares. So if they did somehow buy back 5 million, they also somehow put another 8 million out there. And that's so the whole idea that share buybacks do actually return something to the investors is a myth, and not just based on the examples that I said. There's another economist, I think his name is Robert Arnott, who worked on ERP research as well. He had this ratio that he developed, which basically shows that the overall market dilution always exceeded buybacks by about 2% every year. So it's not just me with these ideas, but the idea of dilution and the calculations of it have always exceeded buybacks historically as well. So whenever CNBC or anyone talks about buybacks, it is a very false statement because they don't pay attention to the dilution. But I will also add, though, that there are companies that do legitimate buybacks too. And you do see their shares outstanding decreasing, like Apple, when I noticed, because they pay dividends probably, they actually do want to buy back their shares so they pay less later, which makes sense, right? They do exist, so not all of them are scams. But to simply assume that buybacks are legitimate is a false statement because there's a lot more to it than that.
Well, I agree. I think part of my reason I don't like the turn of phrase, which you added to, by the way, the whole idea that it should be net buyback. So if the net buybacks are still negative, it's still a dilutive year for that particular company, and so that's not good for shareholders. But there's already a mechanism for returning money to shareholders. It's called a dividend.
Yes. Yeah, and then not only that, but dividends are far more fair to return to shareholders because every shareholder gets it. I mean, the buyback, buyback is, look, there's a reason why buybacks were illegal until 1982 because it was clear way that companies could manipulate it. Not only, even if they have a positive net buyback based on what you said a year, who's to know they're not going to issue another 100 million shares the next year or 2 years later? That's the whole issue with this whole idea of votes and being able to just print whenever you want is that these companies can literally just print and dilute whenever they want.
Right. And another important point I just want to really put an exclamation point on that you made there is that when you do a share buyback, that's not returning money to shareholders. It's returning money to some shareholders who choose to sell in that moment. Everybody else gets nothing from that except an apparent bump in how much their stock might be worth potentially. But it's not returning money to shareholders. That's called a dividend. That happens to everybody. Everybody gets the same cut. Doesn't matter when you hold your shares. If you're holding during the dividend period, you get that, right?
Yeah, exactly. It's much more fair in terms of, and it's also much more noticeable too for shareholders, right?
Yeah.
And also, whenever these companies do buybacks, which is really rare in general, okay, it's really rare, and really what they return when they do a legitimate buyback is really minuscule based on how much they've taken over the years.
Yeah. So I want to keep reiterating this point though. A Ponzi scheme then is some sort of a scheme where where continued money flowing in from new investors is required to pay off old investors, right?
Yes. Yeah.
And so you had a second fallacy that you talked through. I want to make sure I call it out because I'll go to a third one. I just want to make sure people are clear on this. The second fallacy was that the asset value of a stock is the same thing as cash, right? And so you're making this point that we have this, I forget what the number would be today, but in your book, you talk about a $30 trillion stock market. That's apparently its value. There's a lot of people collectively, pensions and individuals and all this stuff, looking at their statements and individually summing it up going, we have $30 trillion to our name, which we can now plan on what we would do with our $30 trillion. But you're saying they actually don't have $30 trillion.
No, not at all. There's only $1.6 trillion in existence in circulation in the monetary system, and about $3.8 trillion in existence in the whole U.S. economy. Now, that's a monetary base, and if you want to talk about the M2, which is probably the most lenient measurement of money, I think it's about 11 trillion or something like that, but which is still really far off from 30 trillion. Okay, really far off. $30 trillion market cap is equal to $0 in real money. The whole idea of market cap and stuff is that it's based on a formula that comes from the exchange of money, which is based on how much the last price of the stock was traded for, multiplied by the shares outstanding. Now, let me give you a funny example. This was not in the book, but just something I kind of looked into over the past couple months. I can actually make Apple shareholders increase their net worth by $48 million if I want to by contributing 1 penny, more into the stock market, okay? And this is how it works, is that Apple shares, there's about 4.8 billion shares outstanding. Let's assume that it's trading at $150 right now, all right? That $150, the market cap, is going to be multiplied by 4.8 billion. If I buy just one share of Apple for $15.01, okay? One share, one more penny.
150 and 1 cent.
Yeah,
Yep.
and 1 cent, 1 penny more. That 1 penny would be multiplied 4.8 billion times, okay? And everyone who owns Apple will see the collective value increase by $48 million by my 1 penny. Okay, so that's a real simple math example just to show you how messed up the market cap formula is.
Well, let's bring up Apple then, because it wasn't that many months ago, Tan, that it was allegedly worth more than $1 trillion. So all the people collectively holding Apple were saying, yeah, we own more than $1 trillion. Today, it's worth a little under $750 billion. So where did that $250 billion go exactly?
Yeah, it's the whole thing. The value of a stock is just an idea. It is purely cerebral and imaginary. It's fundamentally different from real money that people can possess, hold, or hide under their mattresses. The value of a stock comes from the exchange of money, and it's fundamentally different from the money itself that is being exchanged. So the reason why billions and trillions can disappear from the market at any moment is because it's an idea. There's always $0 there. It's just a belief, and it's different from the belief in money value. That's completely different, but it's literally just a belief that, hey, I think I have, $10 million in my account. No, you don't. It's $0, and that's why that idea can fluctuate. If I had $100, right? If anyone had $100 sitting on their table right now, no rumor, okay, no slander, no myth, no book can ever make that money disappear or grow because it's there. But if there's nothing there and you got nothing but an idea, yeah, billions can lose at any moment, millions can lose, whatever, and trillions can lose at any moment because there's simply nothing there, and all you're working on is this idea that it's $1 trillion.
Well, Tan, it's been a very enduring idea. And in your third fallacy, you raised that the stock markets are a positive sum for investors, producing far more winners than losers is a fallacy. First, describe what you mean by positive sum so people have an idea around that term. But really, I want to talk about why is that the fallacy? Because people are convinced. I go to a lot of investing threads and chat rooms and whatnot, and people are convinced you just put money in, don't try and be smart, don't time it, and it will grow. And that is a positive that's very strong for people, that idea of positive growth in the stock market.
Yeah. Well, positive sum basically means that overall, it's actually given investors back more than they contributed on average. So there could be losers, there could be winners, but overall, if you add up all the winners and losers, most of them are winners. So basically, there's going to be more wins. It's a fallacy because one, there's no database that even tracks investor losses. Based directly on what you just said, which is that they see their money grow, so to speak, and they saw their $10,000 portfolio go to $20,000 over the past 5 years. The issue is that's an idea. They have $0 still. Their money isn't really growing. This is a part of the difference between knowing and realizing. They say they know, but they don't realize they have $0. So this whole idea about stocks returning something positive is a complete myth, because not only because of the lack of database that tracks investor losses, but people don't quite understand that the real returns to equity is embedded in something called equity risk premium research, and it is a highly debated subject in terms of what stocks have actually returned to investors. When people actually talk about, well, quote numbers like the stock market has returned 10% over the past century or something, they're not actually quoting what stocks have actually returned. What they are quoting is the S&P 500 index. Mm-hmm. And there are several issues with that in itself. This part wasn't in the book, but it's in my next book later. But here's the issue with the S&P 500. One, the S&P 500 completely ignores the hundreds of thousands of stocks that have been delisted over the market over the past century or so. But even worse is that the S&P 500 isn't actually composed of 500 stocks. It's actually composed of thousands of stocks that were on the S&P 500 list over the years. What the S&P 500 does is it captures the best performing stocks deemed by the S&P, best 500 stocks every single day. But if a company goes out of business that's on the S&P, they'll simply just drop it off and replace it with a new one. Okay, so this is why, if you think about it, Apple, Google, these are on the S&P 500 now, but these companies weren't around back in 1928 or 1970. It's because they replaced the underperforming companies with these new ones. So the S&P 500 is not actually based on a basket of 500 stocks. It's actually based on a basket of thousands of stocks, and they only took the best performing surviving ones and kept recording those returns. So not only does the S&P ignore all the stocks that have been delisted from the market overall, it also ignores the thousands of stocks that the S&P 500 itself delisted from its list over the years. So you got like double survivorship bias there. And most people don't actually understand how that's even calculated. This is why financial advisors and all kinds of people just simply quote it without even understanding where those numbers come from. So this idea that overall people have been making money is a complete fallacy, because no one tracks how much money, real money, investors have actually lost over the years. And what they're really quoting is a really biased index that has severe survivorship bias.
You know, it's as well, obviously there's that really old joke, I think it comes from the 30s, where somebody's in a Wall Street broker's office and the broker's showing how successful they are, and they proudly take them to the window and wave across the harbor and say, look at all the yachts we have. We're a very successful firm. And the customer asks, but where are the customers' yachts, right? And it's back to that Wolf of Wall Street, scene again that I just cited. And it comes down to this idea that when we look at the proprietary trading desks of J.P. Morgan, Goldman Sachs, et cetera, they are have been reporting whole years where they had 0 days of trading losses, which implies zero risk. You have firms like Citadel and Virtu, which are doing high-frequency trading, which are also reporting uninterrupted 0 trading day losses, always pulling money out of the market. Now, how is it possible for big firms like that to pull tens of billions of dollars out of the market and have it still be positive some? Where is that cash coming from? Do we not have a basic accounting problem here?
Oh, yeah, there's tons of basic accounting problems. I mean, if they're taking money out of the market and investors are the only ones contributing money into the market, because Google certainly isn't, then that money has to be coming from investors, which of course makes them have incentive to keep the smoke and mirror going, right? I mean, it's as simple as that. If Google's not paying back anything into the market, companies like Google, Berkshire, they're not paying anything back into the market, and these banks are taking cold hard cash out of the market. It really comes down to that simple aspect. Where is the cash coming from? I don't care about these stories. I don't care about these theories that you can't prove. I want to know about the cash. Mm-hmm. Where's the cash? Just follow where the money is, because ultimately that's what investors care about. And if you guys are taking cash, cold hard cash out of the market, and they're not coming from the companies, well, we better look to the only source that is contributing money into the market, and that is always the investors.
Exactly. So, Tan, look, equities are a claim on something, bonds are a claim on something. Hopefully you have a nice senior bond, so you're at front of the line. Oops, it's PG&E. It turns out some banks just got some debtor in possession financing, and now they're senior to your formerly senior claims. Rules change, all that stuff. It's moving target. But let's make this simple again. Look, the future earnings of a company, as they say, that's what you're claiming when you have an equity. But ultimately, those companies then are a claim on something else, tangible and real. So logical question here for me, how is it possible for those claims, the claims of the equities, to allegedly be growing at 10% a year when their true claim is on the underlying economy, and that's growing at half that rate on a nominal basis? Feels like a math problem to me. You can't compound something at 10% that's a claim on something growing at 5%. It just doesn't work.
Yeah, this was actually what Bill Gross mentioned a couple years ago, too. He basically said equities are a Ponzi scheme in that respect. No, it doesn't work. And it's with respect to how this growth is happening. They're talking about really the growth in the price, which is really derived from the exchange of money between investors and the Ponzi process. It's in the same way that Tesla stocks can shoot up from $20 to $380 while they lose billions. It's the same process. The stock itself is just getting Ponzi'd up in terms of this exchange process, and it can indeed go very high and very because it's completely separate from the fundamentals. It's completely disconnected from, in Tesla's case, the profits of the company, and in your example, the fundamentals of the economy itself.
Yeah, it's just the numbers just don't add up to me. And of course, in my world, what we spend a lot of time doing with my audience is we're also looking at the idea that this era of growth that everybody's formed all of their ideas around how the world works. Well, we always grow. The economy is always 4% bigger, or in China's case, 7% bigger. But when something's compounding at 7% a year, it means it's going to be twice as large in 10 years. And in 20 years, it'll be 4 times as large. And that's just how compounding works, right? So we look at that and we say, well, that can't continue forever. You can't compound infinitely on a finite planet. So if we're at the edge of the end of the growth phase, which I think we are, we have now 15 years of global data that says, wow, the last 15 years growth was a lot lower than the prior periods. So we're trending downward. So here's a question. Equities, they still look really ridiculously expensive to me by historical measures. You're saying they're a Ponzi scheme. Can't disagree with that by logic. But stocks, as they're priced today, seem to be saying a lot of growth is coming and soon. So what are equities worth in a world of either flat or even negative growth, assuming that view comes to pass?
What are equities worth? Well, if an equity doesn't pay dividends, it's worth zero. Because,
all right, that's a good place to start.
Yeah, it's worth zero because it's just a Ponzi asset. The only way you're going to get money back is by giving to another investor. Now, the equities that do pay dividends, then you got to look at some fundamentals, because those things do actually have a monetary connection to the company, and so that's a little bit different. So I don't know exactly what that would be, but basically, the equities that don't pay dividends are just Ponzi assets, and the equities that do, fundamentals and things like that matter.
Well, I had a guest on a while ago, Tan, who talked about the small cap stocks in the Russell 2000 and said, look, they're reporting a PE of 84, but when you go to how this is actually calculated, they put it right in their methodology. They say, oh, by the way, any companies that have no earnings, we excluded them. And anybody that had a price earnings over 40, we called it 40. Right. So they did that whole same thing where it's basic survivorship bias plus also this truncating to get things back down towards the central mean. But as a group, they're yielding something where if you were honest about it, you'd say, I'm going to put $1 into this basket of stocks and I'm going to hope that they return it in 100 years. That would be the earnings profile as it currently stands. So that the only way you can make sense of that in my world is by assuming a very high rate of future growth indefinitely for decades and decades.
Yeah, I mean, I guess so. I'm trying to understand so can you repeat that? Sorry, the example you just mentioned in terms of they put $100 in there and they're waiting for 100 years to return.
If the average price earnings is 100, what you're saying is I'm willing to put $1 in with the expectation that it's going to return 1/100th of that in the next year. So you're waiting 100 years to get your money back from earnings. Not saying they're going to give you your earnings back, but that's what that would point to.
Yeah.
Right?
Yeah, no, it would be. I mean, my whole thing with the whole growth and what people are going to get back is with respect to cash and dividends. I don't care about capital gains, because capital gains are just negatives, are zero sum by design and negative sum in practice. And basically, even if people, because you can't really say capital gains return anything, but even if the earlier investors get their money back, the latter ones are down that money. So by design, there's just zero sum. So whatever the price is in terms of the appreciation in the underlying asset based on capital gains, I don't even consider that to be any kind of returns at all. All I care about is the cash. All I care about is the dividends and how much money the investors are going to make from the company itself.
Well, speaking of this idea of negative sum, not even zero sum, the financialization of the overall economy in the United States and many other industrialized nations has been extraordinary, right? Starting from the time the whole idea of financialization really kicked off in the mid-'80s to currently, I think banks went from about 4% of the economy to financialized returns around 40% of profits. It's astonishing. You worked in a corner of that for a period of time. I'd love to get your point of view now as somebody who maybe has exited and doesn't have a lot to lose by giving your honest impression. But you worked in the hedge fund industry. What sort of value do hedge funds create?
I don't think they create a whole lot of anything. When I first started my hedge fund career. I think in 2007, I read Alan Greenspan's book, Age of Turbulence. And in it, he analogized hedge funds as basically taking out the inefficiencies in the market where kind of like the grease between the gears, so to speak, because there was an inefficiency in the banking between banks and bigger institutions. So he saw hedge funds as these little guys going in there and taking inefficiencies out of the market. And that's kind of what I agreed with because I was ignorant back then. But over the years, after I worked on them for a while, I kind of realized, especially my second hedge fund, which I talk about in chapter 1, is a lot of them are just basically trying to figure out ways to game the system. And really, if anything, they're kind of making things less efficient, and they're just taking money out of the system in very scandalous ways. And that money, of course, has to come from other investors. So the whole hedge fund industry, I'm sure there's some decent ones. So it does, there are exceptions, but overall, I think it's a total scam because they're just people who are trying to game the system. And overall, we simply have absolutely no idea, again, back to the idea of there's no database that tracks investor losses, of whether or not the hedge fund industry is actually creating anything wealth for society, and if they're simply actually just contributing more to the gamble. They're clearly they're not treated as a gambling instrument. Sure, people out there are saying, oh yeah, it's gambling. They're not treated like that. Because why? You can be 18 and you can invest in a hedge fund. You can be 18 and open a trading account. If you think they're gambling, then treat it like gambling. Make it 21, right? But so I don't care if people think hedge funds are gambling. They're not treated as gambling, but they should be. Not only hedge funds, but also just stocks in general. So my perception of hedge funds is they're a total scam because we have absolutely no real data on their success and performance. And based on what I've seen is they don't actually make things more efficient. If anything, they for every efficiency they make, they also contribute a lot less efficiency in other areas by trying to complicate things and trying to game the system and trying to take money out of the system.
Well, did any hedge funds build any bridges last year?
Yeah, that's a good point.
Creating something of value. They make money. I get that. But you wrote in your book, you said the things that are legal in finance are far more destructive than what is illegal in finance. And I assume you're at least some of that you're referring to your period of time there with the life insurance products, right?
The life insurance products and also just overall stocks. The fact that Google C shares exist with no voting, no dividends, and it's clearly meets the definition of a Ponzi scheme. But yeah, it's just insane how people don't quite recognize it for what it is. So.
Well, absolutely. And people, we've been talking with Tan Liu, the author of The Ponzi Factor, The Simple Truth About Investments, which you can find at Amazon. I got it on Kindle. It's well worth your time, even if you want to just come in and dismiss it and critique it or something like that. Good luck, because it's just very simple logic. Tan, you're working on another book you mentioned. What is that?
The title, well, it's going to be another, main title is going to be Ponzi Factor. And it's going to have a different subtitle. Essentially, what it's going to be is the first book that you just mentioned is very readable, more of a story that anyone can understand. The second book is also going to be very readable, but I'm also going to focus a little more on the academic side, on the formulas and things like that, like I explained with how the S&P works and how the market cap formula rewards delusion, and how people can create millions and millions of dollars worth of value for overall investors by just contributing a penny into the stock market. So it's going to focus a little more on those aspects as well. So
excellent. Well, Tan, thank you so much for your time today, and best of luck with that future book and all your future endeavors.
Thank you for having me, Chris. I appreciate it.